Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Shah and you're watching Indian Open this Thursday morning, and it seems like the morning will have a tick of green across. Let's go across straight to the headlines at this hour. The US Federal Reserve Chairman says rates are just below neutral, prompting global markets to assume that there can be a pullback from the projected hikes in 2019. The government releases official backed data of the new GDP series with a base year of 2011-12. Niti Aayog's Rajiv Kumar says it fixes old flaws. Unilever edges out Nestle in the race for GlaxoSmithKline's consumer health unit in India, offers to pay $3 billion for 70% of the division, reports Bloomberg. And a jury in California clears charges on TCS of favoring Indians over locals in America to man its offices in the US. Debt-laden ILFS will invite expressions of interest for its renewable energy assets as part of its asset sale plan. Well, frankly, I don't think there is too much to say but for the fact that it's Fed all the way. It's really about whatever assumptions people would have on the dot plot, whatever assumptions people have had of the quantum of pace of increases that the Fed will do. And by the way, all of that could well still happen. But what the statement of just below normal, just below neutral did was let markets assume that maybe the trajectory of rate hikes could change. Maybe the pace of the rate hikes could change. All of these are assumptions. Keep that in mind. But the market loves to assume. The market moves on sentiment. And that's what's happened yesterday. The Wall Street had a big bang rally in trade ahead of, just after those statements came about. And this is arguably one of the longest or the sharpest rallies in 8 months on Jerome Powell's comments. So that's really the order of the day when it comes to the world markets. It's essentially how the US markets reacted and how the EMs have reacted as well this morning, or would have reacted this morning on the back of this. Frankly, from an EM perspective too, it's a big thing that the Fed rate hikes will not be as steep, if they are not as steep as what the markets would have otherwise believed. Now, keep in mind, we've approached this expiry, and just before we get to the big news of the day, just a quick trade setup on the Indian markets as well. We are likely to start off about 1% higher, but we are approaching this expiry with a fair bit of caution thrown to the winds. The last 3 days we've been in the green. In today's session we are likely to be in the green. The rollovers are just about looking at par or slightly above par as well. So no complaints out there. The rollover front as well. You could argue, depending on what your assumptions were about whether or not today would make us reach par, etc., or so on and so forth. But that notwithstanding, and the levels of what the options data is suggesting for the current series notwithstanding, it's safe to assume that we are nowhere going down to those 10,500, 10,600 levels. That's out of the window completely. In all probability, we'll start off well and stay higher in trade today. FIs continue to pump in money. In yesterday's session, remember we spoke with the nature of the rally that had happened, IT and Reliance doing so well, you would assume that FIs would have pumped in some money, and that's what's happened. 961 crores coming in from the FI side. Just very quickly, those 3 or 4 stocks that you need to watch out for in the session today before we move to the big news, and that's the Fed. The 4 stocks that I thought were the most important ones and ones that could react in trade, those are, well, firstly, HUL in focus. Unilever has Bloomberg News is reporting that Unilever has outbid Nestle. They may acquire 70% of GSK's India consumer business. Do watch out for this one. Indoco Remedies, it's been a stock that's been on a tear for all the right reasons in the recent past. Company-specific news. Now, we're also learning that they've expanding their capacity. They've commissioned the new API facility in Maharashtra. It adds substantial amount of production capability to Indoco. Could react likely in the session today as well. Sikal Logistics, they won an order worth 363 crores from Mahanadi Coal Fields as well. It's not a very large order for another company, but for Sikal, reasonably large order. Let's wait and watch if this stock reacts in the session today. And Shankara Building Products has lost serious amount of market cap, was down about 9% in trade yesterday as well, but the name could evoke a response. Small stake, but Amansa Holdings has bought about 1.28% stake. Let's wait and watch if Shankara Building Products reacts in the session today or not. But frankly, all of this notwithstanding, all about the Fed. Today on First Word, we start off with that. Equity markets the world over are cheering Jerome Powell's dovish stance. What else did he have to say that's got investors charged up? Kathleen Hayes takes us through the details, and then of course we speak to an expert too. Back home, the picture is not as hunky-dory, with 3/4 of the Nifty stocks trading below their 5-year averages. Sameet comes in on that. Unilever may have beat Nestle to back GSK's consumer business in India, but there are a few finer details that still need to be ironed out. PR Sanjay and Agam Vakil take a closer look at the deal. And the Niti Aayog Vice Chairman Rajiv Kumar tries to explain why such a big divergence between the old and the new data series on GDP. But start off with the US Federal Reserve signaled a pause in rate hikes in 2019 following a widely expected increase in December in what was seen as a shift in tone from remarks last month. Jerome Powell said on Wednesday that the recent series of rate hikes brought Fed's policy just below neutral. Bloomberg's Kathleen Hayes reports.
So when you have Fed officials start saying, well, you know, we want to be just above the neutral rate, and now they're saying, well, we're uncertain about the neutral rate, I think that's why it's catching so much attention, because ultimately where the Fed believes the neutral rate is will have a lot to do with where they stop with their interest rate increases. And it seems to me this uncertainty now over where the neutral rate is, and there's a wide range of views on the FOMC, is really kind of at the heart of the Fed debate. And remember, last month, and it's true, it was kind of an off-the-cuff remark to Judy Woodruff by Jay Powell. He said the Fed was still a long way to go from neutral, but this is what he said, probably in a little more measured, thoughtful way today.
Interest rates are still low by historical standards, and they remain just below the range of estimates of that level that would be neutral for the economy. That is neither speeding up nor slowing down growth.
Just below the neutral rate. And this is so interesting. This was a speech about financial stability because the Fed released its first semi-annual financial stability report today, the vast majority of his remarks. But he did start off putting this comment in about how the economy still looks good, inflation's still about where it needs to be, and then this just below neutral rate. Now, another thing that's important here is that Powell also echoed something that Rich Clarida said yesterday. He's the Fed vice chair, in that job just 2 months, saying that the Fed's not on a preset course. To me, this speaks to this sense, well, gee, if the Fed is looking for 3 rate hikes in 2019, this is a preset course. But the Fed doesn't view it that way because they're always assessing the data. Rich Clarida said they're not just assessing the data to figure out, gee, what do we do at the next meeting? They're assessing the data to know, again, where's the neutral rate? Because it can change. It can get higher. It can get lower. I think it's interesting that Mike Feroli over at JP Morgan was writing about this, and he said, look, the range right now for the neutral rate is 2.5% to 3%. At the end of the year, the Fed, with 1 rate hike, will be up around 2.5%.
Right.
So if you're at that end of the range, you've hiked just about enough. If you think that the neutral rate's at 3.5%, you're in the camp maybe it thinks there's a lot more to go. I think we're all learning a lot more about neutral rate than we ever intended to, but obviously it's a big focus for the Fed.
Yeah, well, and maybe it's also a big focus because it's in the market perception, it's a shift from what the market earlier believed. What are the implications for the global markets? Let's talk about that with our next guest. Kevin Karen, do we have him on the line? Okay, we do have Kevin Karen on the line. He's from Washington Crossing Advisors, joins us right now on the show. Kevin, good having you. Thanks so much for joining in. How do you think the markets are reading into it? Is it a deviation, a stark deviation from what the market had assumed about 2019?
Yeah, I think so. But keep in mind that this is something that's been playing out over the last few weeks. We got a big jump in the stock market today. But if you look at how market expectations for Federal Reserve tightening in 2019 had been playing out, as we went through August and September and October, expectations for next year were creeping higher and higher. Well, what happened in early October? The stock market ran right into a wall and has been coming down ever since. So I think what the Fed has done is they've found where they are in this dark room, as Richard Clarida discussed a few weeks ago, and they've realized that at this point they've probably pushed the Fed funds rate close enough to neutral, so they're backing away from that.
Yeah, well, I can tell you one person who will be happy, and that will be Donald Trump. But Kevin, the other question is that world markets are clearly cheering this. Also the implications that it has for emerging markets, because frankly, the fear for almost all EMs would have been that what it does to the US markets is one thing altogether, but higher rates, that rate differential being higher or otherwise would mean more flows into the US markets, and therefore EM funds would see that pressure. Is that a bit of an easing out scenario for EM markets like India and some of the other Asian markets as well?
Yeah, that's exactly right. That's exactly right. But keep in mind that this is all the Fed is now at this point, we think, very data dependent. They're looking at they're taking actions and doing things to affect a very important interest rate, which in turn is impacting asset prices and other things. How those things play out in turn will feed back into what the Fed does next year, and ultimately what the dollar does, and ultimately affects commodity prices and what you're talking about with emerging markets. So Kevin, this is all just a big cycle.
Yeah, Kevin, if I can just come in, and I completely agree. I mean, nowhere are, I think, out here we or anybody else hopefully are trying to say that this is a done deal. But just that shift in communication, would it lead fund managers or global large funds to believe that maybe the pace or the quantum of hikes may not be as steep as we would have thought, and therefore could it lead to some bit of rebalancing of stance and maybe flows over the course of the next 2 or 3 months, just in anticipation? Do you reckon that could happen, or is it too soon to call right now?
It could be, but this has been this backing away of an expectation for more rate hikes next year has been happening for most of the last month. If you looked at the futures market a month and a half ago, there was another 50 basis points almost that it was expected for next year that has almost been backed out at this point.
Yeah. And therefore, the question of whether that gets reversed or no. Okay, Kevin, Karen, just one last question. What do you expect the near term to hold then? Do you expect that brief rally that we had yesterday in the US markets to continue, or again, that is very difficult to call? A 2.5% move on that comment probably takes care of most of the reaction that should have happened.
I think a lot of it was already priced in. I think that we got the confirmation that the market was suspecting over the last few weeks. So probably the biggest upside has already been had. And I wouldn't at all be surprised to see the market trade a little bit more sideways, or maybe even give some of this back in the days ahead.
Okay. I really appreciate you joining us this late in the evening, Kevin. Thank you so much for taking the time out and speaking to us at Bloomberg Quint India. You bet. Thank you. Well, that's Kevin Karen of Washington Crossing Advisors. Well, let's get the next piece on board. If the world markets are cheering, it takes care of some of the recent correction. But remember, what the recent correction has done is take a toll on most blue chips in India. Nearly 3/4 of the stocks on the Nifty are currently trading below their long-term average valuations. Sameet Sarkar joins in to tell us how deep and broad the discounts are, and just exactly the conversation that we should have after this big conversation on the Fed and the market rally. Sameet, fill us in.
So if you see, nearly 37 stocks, that is 75% of the Nifty 50 stocks, are currently trading below their 5-year average valuations. Now, this is the highest in at least 10 years. Now, the closest number to this was in 2016, when nearly 69% of the Nifty 50 stocks were trading at this valuations. And this fall in valuations have prompted HSBC to upgrade India's rating by 1 notch in neutral, but they still remain cautious on the Indian markets, because they say that the reasons which led to this fall in the valuation still exist in the market. In fact, Ajay Srivastava of Dimension Consulting also believes, or in fact advises investors to not do value investing in these kind of market situations, because the market is still that he expects the market to still fall, and that's the reason he's also advising investors to stay away from value investing in the market. Now let's look at the top 10 stocks that are most discounted compared to their long-term average valuations and the possible reasons behind that. Now Tata Motors tops the list. It is at a discount of nearly 83% to its 5-year average valuations valuations, and that is because of the declining sales volume for JLR, especially in China, because of trade wars and because of increasing volatility against the US dollars against the sterling pound. That has impacted the share prices of Tata Motors and the valuations. Now for ONGC, it is mainly the uncertainty in the government policies that have impacted the valuation. For Eicher Motors, an expected slowdown in its star brand, that is the Royal Enfield, and because of the recent plant shutdown issues have impacted and weighed on the valuations of Eicher Motors. For Grasim Industries, if you see, for the standalone business, there's no concern as such, but the company holds stake in various other Aditya Birla Group companies like Ultratech and Vodafone Idea, which are not performing that well and might need fund infusion. That is the main reason why investors are not giving a higher valuation to Grasim Industries. For Coal India, a stake sale by promoter at a large discount and because of slowdown in its volume growth have impacted the share prices and the valuations of Coal India. Now, if you see the other list, which includes Indian Oil Corporation and HPCL, now both the oil marketing companies' valuations have been toned down because of the uncertainty in the government policies. This is followed by Sun Pharma. Now, Sun Pharma's valuations have been lowered because of a delay in realizing the Ranbaxy merger synergies, because of pricing pressure in the US market, that is the key market for Sun Pharma, and because of pending issues related to its key HUL plant, and that have weighed on the valuations of Sun Pharma. Now then there's Indiabulls Housing Finance on the list, which is trading at a discount of nearly 42% to its 5-year average valuation. That was triggered because of the recent crisis seen in the NBFC market, which also triggered a sell-off in the NBFC sector. Last on the list is Yes Bank, which is trading at a discount of nearly 52% to its 5-year average valuation. Now, three reasons that led to this fall in the valuations and impacted the share prices of Yes Bank. Now, first, it was triggered by as RBI denied reappointment of Rana Kapoor as the MD and CEO of the company. This was followed by the rating downgrade, and because of resignation of 3 directors of the company, we are seeing that the valuations of the company are now trading at a 52% discount to its 5-year average valuation.
Okay, Sameet, thanks for putting that into perspective. So discounts galore, and as we've said, maybe a concentrated rally, those 5 or 8 or 10 stocks holding up the index. Otherwise, a lot of index names as well trading at steep discounts to their average valuations. That's Sameet Sarkar bringing in that data. To the news at hand, and Unilever is said to have beat Nestle in the race to acquire GlaxoSmithKline Consumers business in India. This includes the prize brand Horlicks. PR Sanjay of Bloomberg News is here with the details. Well, Sanjay, this news came out last evening. It was talk of town. Tell us what you're learning.
So the last round for Horlicks days was like Nestle, Unilever and Coca-Cola. And what we understood, what sources is telling us that on price-wise, Nestle may have given a good, bid. But at the last round, Unilever has outbid them with great structure, which we had to know what is the kind of a structure which they've offered, and much better than, far better than, superior than Nestle and Coke. So Coke is literally out of the race as of now, and now Unilever holds an edge with the right structure and right valuation, which is not a great valuation, but they're looking for a 4 billion valuation originally, and you would have already seen what had done, Complan, what they were looking for 1 billion, and they've settled for much lesser than that.
But the story, Sanjay, that you filed or Bloomberg News filed also suggested that while it seems like a done deal, there could be a chance that deal might not go through as well. So it's not a done deal, a locked deal as yet. It's a very high probability, I would reckon.
Exactly, you said it. So GSK had done a strategic review. The parent company, even after putting Horlicks brands on the block, they had done a re-review of the sale. So they are not very happy with the valuation. That's why the last round, you could see multiple negotiations, and you could see Nestle again coming with revising bid. Finally, this is what latest we were coming to know that Unilever has put a better bid. But we'll get a clear picture. There's an annual investor event happening on 4th and 5th of December for Unilever, where we'll get much clarity. But before that, Unilever has to put in a stable, clear-cut, price and edge or better structure, because we understand, but we understand that only nutritional brands will go out of it. So how this will pan out, where the whole India portfolio will be bought out, or certain other brands will go to a parent company. So we have to see the right structure, and whoever is putting the right structure with better valuation they'll be the winner.
Well, let me tell you, if indeed they put in a new deal, I'm sure PR Sanjay out here will be flashing it on the Bloomberg terminal and will bring it to you on Bloomberg Quint as well. But, you know, Sanjay, Agam, I think, has gone through a sum of brokerage notes, which have, Agam, I believe, painted a what-if scenario, that what if this goes through, what happens to all the related parties? What are you learning?
Sure. So I'm going to stick to Hindustan Unilever, because since we are talking about that, and Unilever specifically in this case. So Macquarie is of the opinion that it is going to complement Hindustan Unilever's food and refreshment segment. Now that contributes to as much as 20% to your overall revenues at this point in time. But should they go ahead and buy the consumer business of GSK, well, the contribution of revenues could rise to around 27 to 28%. The biggest brands out here that we're talking about is Boost and, of course, Horlicks. Horlicks is, in fact, also a promoter, enlisted promoter in GSK Consumer, holding around 40% in the company. And they're also, and do remember that also 90% of your revenues for GSK Consumer come from Horlicks and Boost together. And this, of course, could complement Hindustan Unilever's food and refreshment portfolio going forward. Of course, we have to remember that it's garnered as much as 4,300 crores in the previous financial year. So that is an addition that could come through for, if it's Unilever or Hindustan Unilever, either ways, it's a benefit for Unilever here.
You would second that, Sanjay?
Yeah, but there are some concerns also. We need to flag certain concerns in the sector as well. So if you see, the market share of these malted drinks are slowly, falling, because there are a lot of options. Earlier there was, you will always recollect, I'm a Complan boy, I'm a Horlicks boy, etc. But now, availability of milk and availability of a lot of other options and so-called organic, natural Ayurvedic drinks, the market is slowly falling. So one will have to, and if we carefully see, these MNCs did not invest properly or did not nourish or nurture these brands to the level it could have been reached. Otherwise they could have actually fended off all this organic, so-called organic drinks market. But one will have to wait and watch how Hindustan Unilever will integrate to get into the next level. Whether they invest, they will have to do a lot of work to get it into the original shape.
Wow.
Just a word on distribution here. GSK Consumer brand has distributors which come to around 1.8 million. Hindustan Unilever is much larger at 7 million. So there are a lot of synergies with respect to distribution. And of course, as we know that Hindustan Unilever has a very efficient, old marketing, well-oiled marketing machine in place. GSK has not been taking, its marketing so seriously, considering, as Sanjay has already mentioned, that to a certain extent they have been losing out market share here. So should these brands come together, of course, it's going to be a win-win for both.
Yeah, but in a situation wherein the brand, that category itself is kind of falling out of favor as well. So it's an interesting deal. Let's see if there is more in store, of course, if this deal goes through in the first place. But Sanjay, Agam, thank you so much, both of you, for joining in and putting perspective out there. Well, that's the big news, to be honest, the big business news of the day, assuming that it happens. The last piece on First Word today is the debate over the GDP numbers, and that continues. The government released a new data series on Wednesday, which is in sharp contrast to the earlier data series released by the NSC. Working with 2011 and 2012, or 2011-12 as a base, as a new base, the new numbers have moderated the growth rate substantially during the UPA regime, triggering a political debate out here. But Niti Aayog Vice Chairman Rajiv Kumar says that the new method fixes old wrongs. Ida Duggal spoke to Kumar and started off by asking him for his key takeaway from this new number.
Back series down released this time have generally increase the level of the GDP at constant prices, so that you can see that there is a increase in the level of the activity, but the growth rate has tended to come down, because you can't keep both, you can't have both sort of growing at the same rate. So I think the new data that has been now released has been estimated by much superior methodology, has had a much larger data source. The data coverage is much better, and now it's much more in sync with the system of national accounts of UN 2008, and therefore makes our data far more globally comparable than what the earlier series was. So I think we can go into the details of how all the data coverage that I've talked to you of methodology is much better, but let me assure you that this has been vetted very seriously and very rigorously by some of the country's best statistical minds and experts, for which the Niti Aayog had arranged 2 round tables, on which this data was discussed, and we took the trouble to make sure over a period of a month that what's put out is rigorously as good and methodologically as robust as is possible.
Mr. Kumar, whether you like it or not, this debate has already been politicized. The GDP story, especially the back data, it's already been politicized. So I have to ask you this question. You're saying that this methodology was arrived at. You did not tell me when it was arrived at. And also, sir, the point being made is that the biggest adjustment has come in that 1 year when both the old series and the Statistical Commission data was suggesting 10% growth. And now this series is bringing that down to 8%. So the biggest adjustment seems to fit into the political narrative of which government saw faster growth. Where was it the UPA or was it the NDA?
No, this is impossible. I think this is just not right, and I think it's completely wrong and it's completely ill-timed to politicize this whole discussion. There is nothing political about this discussion at all. The difference between an average of 1.7 percentage points exists throughout the period and not just for that 1 year that you are mentioning. That's not true at all. And as I said, this difference comes because the earlier series, with the base of 2004-5, had consistently overestimated the growth of the tertiary sector. The growth of the tertiary sector, whose share therefore had gone up to 53, 54 on sorts of percent, and which has now come down. And within that tertiary sector, it is those 3 sectors. It is the informal trade and the financial services and telecommunications, which have really been the major overestimation. In some sense, CSO is now saying that we accept our weakness in the past to have overestimated that. There are very good reasons given for that. You should see the press note. I could explain that to you or myself. Just as an example, in the telecommunications sector, they estimated the growth rate by the growth in the number of mobile phone subscribers. Everybody would tell you is not the right way to estimate a growth which is going into the GDP. The new estimation is done in the growth of the minute of data and voice used in the mobile phone sector, and which is much closer to value added than you can get. Now there are similar, for example, RBI. The UN system of national accounts tells us, should the central bank and the RBI should not be treated as a market entity, should be treated as a non-market activity, and therefore that data drops out in the estimation of the GDP and the GVA. So there are a large number of such methodological improvements that have been done.
Well, that debate, you can of course watch this entire conversation on our website, bloombergquint.com as well. But that brings us to the end of First Word. Lots more lined up on Indian Open, though. We discuss the impact of what the Fed has done and what it would mean for Indian markets with the local fund manager, Harsha Upadhyaya of Kotak Mahindra AMC would be joining in to talk about his thoughts on markets and all the global developments. And then the steel demand-supply dynamics in the face of the trade war with JSW Steel's Seshagiri Rao. But after this break, a full tilt towards the day's trade.
It's not about the award. It never is. It's about what went before and what came after.
It's about getting recognized for the trust and confidence the customer has shown on us. We actually strive for it.
It's about the brightest ideas and cleverest implementations. It's about innovation.
It's about impact for manufacturers and help for shoppers. Tangible, meaningful impact for manufacturers who innovate and genuine help for shoppers looking for the best new things on the shelves.
It's not about the award. It is about standing out. It's about being a giant even if you're really, really small. It's about picking the leaders of tomorrow, today. It's not about the award. It's about competing.
It's about an unbiased, countrywide, face-to-face consumer survey that is unique and provides relevance and differentiation. Essentially, we're adding something to the marketing arsenal of product teams.
It's about doing one's best and raising the bar each time.
So it's about the end customer. If you have that clarity, what is this need that you're trying to solve for the end customer?
About exceeding expectations. About going all in. Coming. Product of the year.
It's about feeling good that we are associated with Product of the Year. This is our 10th year.
30 years of finding brands that capture a billion.
Welcome, you're watching Indian Open right here on Bloomberg. Quint, a quick glance at what's been happening in the Asian equity markets, which seem to be up and about in trade today. Nikkei 225 almost 1% higher, Shanghai marginally in the green, while Hang Seng trades in the red by 0.1%. But the SGX Nifty, though, extremely promising start this morning, so closer to about 0.75%. That's come off a bit from the highs. It was up almost 1% just a few minutes ago, and now it's up about 0.75%. But this is all on the back of commentary, dovish commentary coming in from the Fed Chairman Jerome Powell, and the possibility that the markets are now seeing that the pace of the Fed increases may likely come off, or even to that matter, just one for the next year or so. That's at least what the euro-dollar futures are suggesting, what the market is pricing in. But let's take a look at our markets. Today is the futures and options expiry day for the series of November. It's going to be crucial and important to keep track of how rollovers are shaping up and where exactly is the next month build-up happening. Darshan Mehta is standing by with all of those details. Darshan, good morning.
Good morning. And the SGX Nifty is indicating a gap-up opening. We open close to the 10,800 mark in trade. Rollovers are decent at this point of time. The Nifty rollovers at 48%, and they will pick up as the day progresses. But yesterday, the Nifty was up while the bank Nifty was flat, given that only 5 or 6 good Nifty stocks, the heavyweight Nifty stocks managed to move. The bank Nifty rollovers are at 39% currently. Where our positions taken, what we're seeing is the fact that call writers are active from 10,700 to higher levels and put writers from 10,700 to lower levels. We probably will open close to the 10,800 mark in trade, which will mean that call writers will have to shed position and put writers will become much more aggressive. And that was something that we saw in trade yesterday also. If we saw what happened in trade yesterday, put writers were aggressive at 10,700. Today they will be aggressive at the 10,800 mark in trade. Which are the stocks in the F&O band? Adani Enterprises, Adani Power were there. Dewan Housing comes back into the F&O band, and Jet Airways goes out of the F&O band. So you will have to focus on Jet Airways, where probably some wild swings can be anticipated. The Nifty PCR moved up. The bank Nifty PCR came down in trade. And the stocks in focus that you need to watch out for, these are the counters in which open interest decline was seen. United Breweries saw open interest decline of 75%. It was down almost 1.7%. PVR and KPIT Tech were up in trade yesterday.
All right, Darshan, thanks very much for that. That's the futures and options wrap out right now. But since it's expiry, let's get in a derivatives expert to talk a little bit more on whether or not trading positions can be taken and what would the expiry likely look like. So we've got Bhavin, Mehta, derivative strategy at Dolat Capital. He's joining us right now on the show. Bhavin, thanks very much for taking out the time. Just set it up for us as we move into the November series expiry, and what would trades look like this afternoon?
Okay, so what we are anticipating is that, Bank Nifty specifically and few of the constituent of Bank Nifty should come under pressure. There could be beware-based selling. During this particular expiry, if you look at Nifty, Bank Nifty and Midcap 100, all of them have gained anywhere between 6 to 7%. However, having said that, what we are looking at is Bank Nifty over last 2 months has outperformed Nifty a big time. It's close to about 5% clear outperformance. So with FI on the sell side, still for this particular expiry in the cash segment, combined with index futures still on a net short side from FI, and single stock futures consistently being trimmed off, anticipating pressure coming in at higher levels. Now today, definitely with gap up opening, we may see markets opening closer to 10,780 to 10,790. However, yesterday, as Darshan has already pointed out, 10,800 has witnessed good amount of call writing, so that level on the higher side should remain a crucial hurdle. At the same time, for Bank Nifty, 26,500 over last 3 weekly expiry, we have failed to close above this particular level despite multiple attempts. So on higher side, 26,500 on Bank Nifty remains very crucial. It has to close above the same level for major uptick. However, being an expiry day today and stocks like ICICI Bank and HDFC Bank coming under VWAP selling pressure, we anticipate Bank Nifty to underperform Nifty.
Okay, for the next series as we move in, where do you expect the bulk of the build-up to be in terms of, a resistance level that we'll see on the Nifty, and whether or not you will be taking any positions in stocks as we head into expiry by afternoon?
Okay, so stocks, now tomorrow there is MSCI rebel. At the same time, we are going to see CPSE FFO flows. So definitely PSU should continue to remain under pressure. We are anticipating sell on GAIL. BPCL2 can remain under pressure. Divi's Lab can be another candidate that should continue to remain under pressure. Majority of these names were witnessing good amount of selling in yesterday's trade, and we anticipate the same to get carried forward in today's trade. Apart from these particular names, MSIL, HDFC Bank, IndusInd Bank, ICICI Bank are few of the names where large cap names where we are anticipating selling. As far as Nifty level goes, definitely we will see some amount of unwinding from the short side. However, 10,800 remains a fairly strong resistance at this particular point of time, and for Bank Nifty it is closer to 26,500.
Okay, Bhavin, we'll leave it at that. Thanks so much for taking the time out and being with us today on Bloomberg Quint.
Thank you.
More bad news for Yes Bank, the top loser in trade yesterday after Moody's ICRA 2 has downgraded the lender's credit rating, citing corporate governance concerns. Let's discuss the rationale behind the move with Anil Gupta, Vice President at ICRA. Anil, good having you. Thanks much for joining in. Not only have you downgraded the ratings, you've also warned of further cuts on adverse developments. The rationale behind the downgrade, and what is it that you would look out for within Yes Bank's stable that could lead you to further cut the ratings?
Yeah, hi, good morning. So I'd like to update the issuers that we had earlier placed the rating on negative watch around 10 to 12 days back. And subsequent to that rating action, there have been incremental resignations from the board, which talks about not that the director was not happy with the way the board matters were conducted. So basically, that actually raised some concerns on the practices of the corporate governance at the bank. So that was one of the reasons that we have cut the rating incrementally after we have placed the rating on negative watch. And the initial rating watch and the current rating watch basically is driven by the weakened ability of the bank to raise capital, because our rating is always factored in that the bank has a strong ability to raise the capital. And as per our expectations, the bank was due for a capital raise in fourth quarter of 2000 financial year 19. So definitely, as per the current scenario, we don't expect that capital raising will be possible by the end of the fourth quarter, and it may get maybe there's an uncertainty to that extent. And in the meanwhile, what has happened is that the banks, because of its growth, they have consumed their capital, and the capital cushions have weakened. So broadly, this is one of the reasons that the rating has been placed on the negative outlook, that the ability to raise capital has weakened for the banks. Apart from that, we are also concerned on the divergences and the serious note which has been taken by RBI for these divergences. And in case the divergences were to reoccur for the March 18, then possibly we will have to relook at the rating. That can lead to a further downgrade, because in case the asset quality deteriorates upon the outcome of divergences, that can also lead to a rating downgrade.
So is asset quality the only criteria that you're going to be on the watch out for further downgrades, or the other operational matrices will also be watched out for? Because I believe, a deposit base seems to be stable for the bank.
Yes, so that is the good thing, that the deposit base has remained stable for the bank among all these events which are happening. So that is a positive thing, but because again there is a significant reliance on the wholesale funding for the bank, so we need to watch out for the deposit levels and the liquidity for the bank. So though we don't expect that should be an issue in the near term, and because the bank is expected to finalize the new MD and CEO, so the operations at the bank should stabilize. So we'll look forward to, as soon as the situation stabilizes and there is no challenge in terms of deposits and the liquidity. But in case there is some issues which emerge, then definitely that will be a rating sensitivity. Apart from that, if you look at, we have also mentioned that the asset quality divergences which can lead to a deterioration in asset quality, that will continue to remain a sensitivity for a downgrade.
All right, got that. Mr. Gupta, thanks very much for those quick comments with regards to why they've actually gone ahead and downgraded the long-term debt ratings for some of Yes Bank's paper. But they're going to be monitoring closely in terms of what comes out of the announcement with regards to the future MD and CEO at the bank, their capital raising plans and how that gets affected, and the divergences in the asset quality for Yes Bank. The stock yesterday plummeted 11.5%. Let's bring in a market voice then. We've got Parthiv Shah, who's joining in right now with his views on the market. Parthiv, good morning to you. And we'll start off with Yes Bank, since we're on the topic. 11% given up yesterday. A lot of issues surrounding capital raising plans for the bank and how that gets affected. Divergences in the asset quality. How are you reading into what's happening with the bank?
Good morning, Devna. I just overheard the talk about the deposit base being stable. Very unfortunately, this bank being almost daily in the news, and now I think many of the rating agencies probably, I wished the downgrade would have happened when the share price was a lot higher. At least there would be a good sense about what's happening with the bank. But that's how the rating agencies are. I mean, they are never ahead of the curve. So I think with all due respect to their business model, but still that's the case world over. The worry is now this deposit base, I think we've seen it in the past, even in likes of a huge franchisee like that of ICICI Bank. Whenever there is any sort of panic which spreads like a contagion, I think we have seen people keeping lines and trying to remove their deposit base. If something of that sort were to happen, it would be really catastrophic for the liability franchisee. So this is a big overhead risk. Despite all the risk in terms of the NPA divergence, in terms of the lack of ability now for the bank to raise capital. They have very successfully raised almost $1 billion using QIP when the share price was a lot higher. And now the ability to raise money has totally dried up. And even if they were to raise money, the key question is at what cost. So I think the spreads are going to get hurt. No doubt the stock has, I think, really gotten massacred, and I think probably one might want to believe that a lot of negative is priced into. So my sense is, I think, probably not very brave enough to talk about, buying an investment call in this bank. Because, we have seen in the past how even a big franchisees can go for a toss. So I think I would prefer the clarity to emerge, and I think it's better to buy the bank a few 30-40 rupees higher, but only once there is clarity in terms of what happens after the change of management, what happens in terms of the divergences and key other questions. Just in case one still feels this is the only private sector bank to bet on in terms of the valuations, go ahead, but certainly with an investment stop loss. I think it's very important to have an investment stop loss in stocks like Yes Bank.
Okay. Parthiv, just stay on with us. Lots more to talk about with you. But let's go across to our research team, all of them standing by right now to talk us through what's happening with some stocks and news, brokerage reports that have come out, and Tata Steel's analyst meet and what came out of there. So let's start off with that, Darshan, the Tata Steel analyst meet.
Yeah, so basically what exactly is happening is they uploaded an investor presentation yesterday. They also had an analyst meet, and the key takeaways, first of all, is that the focus will clearly remain on the India business business from a 44% overseas operation. By 2020, they expect that to come down to just 7%. So they're looking from a current 18 million ton per annum capacity. By 2025, they're looking at a 30 million ton capacity. So that means they're focusing mainly on the India market to drive growth and return for the shareholders. They're saying that the existing project pipeline they have will take it from 18 million to close to 25 million tons, and the balance 5 million tons will come in because they're open to any kind of inorganic route that will come in or acquisitions that will come in. They're saying that the Kalinganagar phase 2 of 5 million ton would significantly improve the product mix, and that will improve the margin. They're focusing on the B2C segment to enrich product mix, increase cost efficiency and drive margins for the company. On the analyst meet, they say, and when asked about the Bhushan Power acquisition, they are not looking at any kind of price war with JSW Steel to get this asset. The focus now remains deleveraging. The current debt on the books is close to almost 1,20,000 crore. By FY20, they expected to get it close to 90 to 95,000 crores. 20,000 crores will come in because of the European operations joint venture synergies that they will come in, and additional 5 to 7,000 crores will come in from the sale of non-core assets which they have identified. So they're looking at close to a 20,000 crore debt reduction, and they're saying that they will now fund the balance capex by internal accruals and not going for any kind of increase as far as their gross debt levels are concerned.
Got that. That's Tata Steel for you. What about some brokerage calls this morning?
Well, there are a couple of them. Jefferies came out with this note on tyre companies where they have initiated coverage on Apollo Tyres and SEAT. Now, according to the brokerage, low raw material prices, improved product mix and the upcoming replacement demand are all positive for the tyre companies. Now, the brokerage is also expecting a price hike in tyre prices that is expected to come in this month of around 3 to 5%, which would not only aid the revenues of the company but also expand the margins of the tyre companies going forward. Now, along with this, the brokerage is also expecting an uptick in realization, which would be led by the technology changes and because of the increase in share of replacement demand. Now, the brokerage has initiated coverage on Apollo Tyres and SEAT, but it prefers Apollo Tyres over SEAT on the back of its better than expected growth visibility, lower leverage and inexpensive valuations. Now, for Apollo Tyres, it's a buy rating with a target price of 290, and for SEAT, it's a buy rating with a target price of around 1,520. Now, the second note is on HSBC on oil marketing companies. Now, according to the brokerage, with fall in oil prices, not only margins of the oil marketing companies will normalize sooner, but the chances of policy risk have also lowered for the oil marketing companies. Now, the brokerage is also expecting the refining business of the oil marketing companies to remain the key engine for growth in financial year 2020 because of the IMO 2020 regulations, which would kick in from the 1st of January 2020. Lastly, it says that despite this fall in crude prices, investors' confidence has been lowered on oil marketing companies, which should gradually improve in coming months, as it is expecting the government to change or manage oil prices through changes in taxes and not through changes in retail prices. Now, for all the three oil marketing companies, the brokerage has hiked the target price and maintained its buy rating. For Indian Oil Corporation, they have increased the target price to 176 from 174, for BPCL to 392 from 360, and for HPCL, they have hiked the target price to 300 from 260.
All right, got that. So a few more brokerage calls coming in there. And what about some stocks and news, Yash?
I'll start with TCS, and the big news over here is the company being cleared by the US jury of any claims with respect to anti-American bias favoring Indian workers over American workers. Sikka Logistics, that one too has received an order of about 364 crore rupees, so that would be in focus as well. Cosmos Films could come under pressure after the company has decided against going with the commissioning of its new BOPT manufacturing line in Maharashtra and has delayed the commissioning by about 8 to 10 quarters. Indoco Remedies, the positive news flow continues after the company said that it has started operations at its new API manufacturing facility. Now, with this, their total manufacturing capacity would expand from the current 150 tons per annum to 600 tons per annum, which is a fourfold increase, by the way. Again, we'll be looking out for TCS as well, because the company has also announced the acquisition of US-based consulting firm Bridgepoint Group, which falls under the BFSI category. Vakrangi too could see some action today yesterday after the company received the clean sheet from market regulator SEBI for any stock price manipulation by the promoters. However, it has been observed that there has been delay with respect to the recognition of promoter shareholding, and the market regulator has warned them with respect to that. The key bulk deal to watch out for would be Shankara Building Products, wherein Amansa Holdings has acquired close to 1.3% stake in the company. So watch out for that one as well.
Okay, great. Thanks a lot for that. A lot of stocks to watch out for, and whether or not they have any kind of a bearing on the stock prices this morning. But since we are on the topic of IT, Parthiv, just come to you. Yesterday was a big bang move for not just the large cap IT names, the mid cap IT names alike. So you had Mindtree, Emphasis, Persistent, First Source, everything doing well. Would you be a buyer in mid cap IT now?
See, I still am a little wary in terms of the mid-cap IT valuations, and also no doubt some of the mid-cap IT companies have shown a very nice transition in terms of the change in the business model, going more into the high margin, high growth digital segment. But still, I think the valuations currently that many of the mid-cap IT are having, despite the correction that we are seeing from the peak valuation, are a lot higher than the large cap names. And somehow I find the large cap names a lot more comforting because there's a lot better deal pipeline visibility. Say likes of TCS. TCS has cracked many billion-dollar deals, and that too long-term in nature, which gives visibility of the sustainability of the earnings. So is the case with likes of Infosys and their ability to have decent size inorganic acquisition. I believe that over the next 2 to 3 years, I think inorganic growth strategy is going to be key, because I think to develop a new technology from scratch is going to be difficult, but buying up startups in the digital segment and adding scale to your existing business model and synergizing that is going to be the key driver of growth for many of the IT companies. And all the top 3 IT companies having the scale in terms of the balance sheet, the free cash flow generation ability as a percentage of their revenues is one of the far better as compared to many of the mid-cap IT, where the business model could go haywire if 1 or 2 products or services don't work. So I would still stick my neck out and feel that names like TCS, Infosys, HCL Technologies, I think if one has to have an IT allocation in a portfolio, these are the 3 stocks that I'll be more comfortable riding with over the next 3 to 5 years.
Okay, well, since you're talking about IT and it's 8:50, it's time for our special segment, Bloomberg Edge, wherein Yash Upadhyaya tells us about a pattern that the Bloomberg terminal has thrown upon a stock, and it is a mid-cap IT stock on his radar today. Yash, what is the terminal telling us about Mindtree?
Absolutely, Neeraj, it is Mindtree, and a positive call coming in with a buy rating coming after the stock has crossed the crucial 21-day exponential moving average. Now, why do we look at the 21-day exponential moving average? Well, that is because it is a more efficient indicator when it comes to the moving averages, as it gives a higher preference or more weight to the latest data, smoothing out the effect for any wild price changes, and reacts better to recent price moves, and is also better suited when it comes to trending markets. Now let's take a look at the chart again, and the pink line over here, that is the 21-day exponential moving average, and with the big move that we saw yesterday of 6.5%, it has managed to close above that. Now the 21-day exponential moving average has been a key resistance level for the stock. It has time and again tested these levels, but has not been able to breach it, but finally with the kind of move that we saw yesterday, it has gone above, and the fact is that there could be room for further upside from these levels.
Okay, and what about the efficacy of this indicator, Yash?
So 5 out of the 7 times that the indicator has turned positive, it would have given you positive returns had you gone long on the stock, and the average return over the last 1 year is of about 17.5% on these buy calls.
Wow, post the buy call being generated.
Absolutely.
Interesting. Thanks a lot for that, Yash. Let's talk about the charts then on some of these, and in fact get in our chartists to talk about the market charts as well. Aditya Agarwala, technical analyst at Yes Securities, with us on the show. In a bit we'll get another expert too. Aditya, good having you. Thanks much for joining.
Pleasure. Thank you so much.
Just a word on IT. I mean, is that possibility that the bounce could last for 10-15% longer? Almost everything is moving up.
I would agree. There's a huge possibility that the bounce back that we saw in trade yesterday and day before can extend further to minimum 10-15%. And look at the small cap IT names, they're yet to perform. So yesterday was more about Infosys, TCS, though mid-cap IT names also chipped in. But look at the way they've fallen. Look at Persistent, the way it has fallen. Look at Hexaware, the way it has fallen. They're yet to get back to those levels. And there's big move left in those stocks. Large cap IT names definitely in some time they'll be again trading at all-time highs. But if you take a look at Hexaware, if you take a look at Persistent, I believe there is another 15 to 20% also in the making in these stocks. Same goes with Mindtree as well, as Yash pointed out. So there's a big move which can be expected in Mindtree as well.
Interesting. Let's wait and watch there. Since we're on the topic of stocks, let's first discuss your stock ideas, then we'll get to the index.
Sure.
Aditya, what are the stocks you're recommending?
So I've got two buy recommendations purely because of the way the markets are slated to open with a big bag opening. So Jet Airways is on my radar after a long consolidation and a steep fall. It's on the verge of a breakout from a bullish flag pattern basically. So post an up move, stock went into a minor consolidation and now it's on the verge of a breakout from this flag pattern. At close to about 308, 310, I'll go long on the stock. Targets out here will be 345. I'll keep a stop loss at 288. There's a big move that can come in Jet Airways as well as Indigo. I picked up Jet Airways and look at the crude oil. It's also trading below $60. So that will be a comforting thing for Jet Airways as well. So the second stock on my buy list is Reliance Industries. That too is showing some signs of strength. Yesterday the stock was up 2%. Big move as far as Reliance is concerned. Volumes were good. So I'm going long on Reliance Industries at current levels of 1150. Targets out here will be about 1195. One can keep a stop loss at around 1125. So both buy calls.
Interesting. Just a quick update on the index as well. Are you taking a trade on the Nifty? It will start off at about 10,800. Is there a trade left?
No, because it just covers up the gap area. So between 10,800 to about 10,750, there was a gap area which the index wasn't able to take out, and 200 DMA was acting like a stiff resistance. It made an attempt yesterday. It made an attempt a couple of weeks back. Today, it finally is managing to open with a gap up. So I will clearly wait for markets to stabilize close to about post this gap up opening, probably a dip of 30-40 points will give me a room to go long in the market. So close to about 10,760 to about 10,750 is a good level, comforting level for me to go long, just above the 200 DMA, and targets would be at as high as 10,860 then.
Interesting. Parthiv, amongst the stocks in news, and this one is in news for the kind of fall that it has had, Shankara Building Products, all through the last few days, it's only gone one way and that is down. But an interesting activity yesterday, Amansa buying in a small stake out here, and Akash Prakash's name does evoke some response. The management has set up an analyst call tomorrow as well to try and explain their situation. Would you be a brave heart into Shankara on the because the valuations are so compelling, or would you want to hear about the growth trajectory before you take a call?
I think fair call, Neeraj. I would certainly want to wait on the sideline, not wanting to be brave, because I think there's something that the market is aware of, such that the stock has fallen from highs of almost 1800 levels to almost half and probably nearing the IPO price range. And I think despite all the talk about GST being beneficial to such a retailer who's in the construction space, and I think despite the fact that the management pedigree in terms of the educational qualifications coming from the IIM background and all of that, I think does not bode well in terms of the sentiment that the stock has seen recently. Never a big fan of trying to follow a credible investor who's bought into a stock, and that's why having conviction to buy it. I would certainly want to wait on the sidelines, see the cash flow statements for some time, because generally such stories fail, and the end of the day when we were to conclude that what went wrong is the cash flow mismatch. And unfortunately this company does not have a lot of listing data, post-listing data. So I think I would not be a brave heart. I would wait on the sideline, see how things pan out, and I think then take a call.
All right, that's Shankara Building. Remember, when they announced their Q2 numbers, post that, the stock has definitely seen a big slide coming in there. Last 1 month, the stock's given out 40-odd%. Another stock that's probably doing okay for itself and comes into the news on and off within the power space is Adani Power. Yesterday's session saw a good build-up. You saw the counter trading 7.5% higher by close. In the last 1 month, the stock has given you returns of about 30%. And an interesting play there, Aditya. What will you do with Adani Power?
So absolutely right, volumes have been healthy. The biggest factor behind this up move is it's backed by good volumes, so which is a good comforting sign for me. Support levels at around 52. I will look to go long in Adani Power. I generally don't recommend a long on Adani Power, but looking at the move that the stock has given in the last 1 month, it's up almost 60%. So I will go long even at current levels, close to about 54. Targets out here could be as high as 62 also. So a good sharp up move still left in the stock. Close to about 50 should be a good support zone. In the zone of 50 to about 52, I'll go long for targets of 62.
All right, we've got a minute left to go. Sameet Chavan is joining in. Sameet, we have time just to get in a quick call from you on the index, whether you would trade it or no right now before we hit pre-open.
See, in last 3 days, we have already seen a good recovery from lower levels. So it seems that at least in the near term, 10,500 has become a strong base. And now, if we see in last couple of days, the put writers have become quite active. First toward 10,600, then toward 10,700. And now, as SGX Nifty is indicating a good bump up at the opening, we'll have to see how index behaves around 10,800. If it manages to stay beyond 10,800, then this move is likely to extend. Then we would expect Nifty to head toward 10,900, 10,920. So first half an hour would be quite crucial. If index trades about 10,800, one can take a long, keep a stop loss 40, 50 points below 10,800, and then we would expect a good move toward 10,900.
Okay, that's a quick call by Sameet Chavan on the Nifty. 30 seconds left to go for market pre-open. And looks like we're going to have a big bang start this morning. The SGX Nifty is at least indicating the same. You've got some strength building up in the Nikkei as well. That's up about 1%. Shanghai, Hang Seng, both of them not doing a whole lot much. But the SGX Nifty are very strong. A whole percent there. 10,800 breached on SGX Nifty. Remember, for our markets as well, for the Nifty 50, 10,800 is very critical because that's where the maximum amount of resistance comes in, and whether or not we're able to take that down goes to be seen considering today is expiry. That's the Nifty pre-open on your screens, about 0.5% on the Nifty 50. Sensex is trading with gains of about 1%, but these prices will come off. You'll see some stabilization coming in there. So we'll quickly look at some stocks and how they've opened up a trade this morning. Yes Bank in particular should pull that stock up to see whether or not yesterday's 11% cut has led to some further cuts in today's session or no. So it's still down, but just about 0.5% post that 11% cut in yesterday's session. JSW Steel stocks at 305, down 1.25%. Wipro is down 1%. But the number of losers, just a handful of them. So closer to about 6 stocks declining on the Nifty 50. In fact, they are sort of picking up from there. So gains coming into stocks like Bharti Airtel, 3% higher. That's the top performer right now at pre-open. HCL Tech is up 2.7%. HPCL is up 2.5%. Vedanta, Bajaj Auto, 1.5% higher. BPCL, Indiabulls Housing, IndusInd Bank. But I need to pull up the currency. We're just a smidge away from breaking 70 on the downside. The strength that's coming to, it's a big move on the currency this morning. So almost 1% in terms of the strength that we're seeing. So yesterday's close somewhere around 7.6162 and already approaching the break of 70 this morning. So that's going to be crucial to watch out for, and whether or not the supporting the currency market percolates into the equity market enthusiasm that we're any which way seeing right now.
Yeah, I think let's see if we break on the upside on above 70 or no. But well, this is nearly there, and it just shows the way the markets are reacting world over to what the Fed had to say. I would presume it's a factor of that. It's disguising all the stocks with slightly poor set of news as well. Yes Bank is just marginally off. You could argue that Yes Bank, of course, had fallen so much over the last few days that today would be this kind of a reaction. However, what's happening across the broader end of the spectrum, let's highlight that. Firstly, the winners, because there would be a few. There is some strength in a Max Financial, about 8.5% higher. Arvind, which relisted or that ARM listed yesterday, continues to do well. So that one is marginally higher in trade. Inox Leisure about 3% higher. Indoco Remedies, a stock in news, up about 3% higher. So good going there. Midcap IT, the likes of Firstsource, Persistent, Mindtree, all of which had a brisk start in trade or brisk day in trade yesterday. Let's see if they are moving on further. Yes, marginally higher for Firstsource. Just about quiet for Mindtree right now. Persistent Systems was up about 6% higher. Hexaware wasn't quite there yesterday, but Persistent was. But yeah, maybe they are a bit unchanged right now. I think they'll all come around in just moments from now. Let's give these rates a chance to stabilize. Just one last name, Shankara Building Products. Let's see if a positive day brings about some reaction, positive or no, from that one. Early days as yet, but looks like could start off on a positive note. The bond yields, if you can just bring up the 10-year yield as well and just see what's happening there while the currency is doing what it is doing. The bond yields at 7.61. That's remarkable strength for the yields as well. So good going really for the 10-year paper as well as for the currency in the session today. Well, Sameet, Chavan, you give us the index view. Just one quick thought on the Nifty Bank as well. A derivative guest who had come earlier mentioned that he thought that the Nifty Bank could underperform the index today. What would you do in the session today on the index from an expiry perspective?
See, I would differ. Bank Nifty is the one component that has been clearly outperforming. If you see, since last many days, Nifty has been struggling to surpass its 200-day moving average, which is placed in the zone of 10,750. But at the same time, banking index has been convincingly trading above its 200-day moving average. In last 3 days, we have already seen good recovery from 200-day moving average, which is a positive sign. And day before yesterday, there was a breakout from its recent hurdle of 26,350 on a closing basis. Yes, yesterday we saw some kind of underperformance, but if you look at the overall heavyweight constituents within banking index like HDFC Bank, Axis Bank, ICRA Bank for that matter, they have been doing well. And just looking at the overall structure on Bank Nifty, we expect Bank Nifty to head towards 26,650 to 26,800 over the next few days. So if Nifty has to stay beyond 10,800, the Bank Nifty will play a vital role in that move.
All right, interestingly, the Nifty in pre-open has breached 10,800. 10,809 is where the Nifty 50 is currently perched at, and Sensex also very close to taking down 36,000. So, I mean, we've seen our fair share of cuts, but, from the peak, we dipped down almost 13-14% on the index. From there, it's been quite a remarkable recovery, regaining ground by almost 8-9% already, back to 10,800 now. Let's talk a little bit more about some of these metal names, and in particular steel. Parthiv, come to you. Now that we are talking about, the Chinese export prices being at Indian prices being at a marginal premium to Chinese prices, what does that do for Indian steel manufacturers now, and how does this play out for them?
See, certainly, I think the reaction that we have seen in many of the steel stocks, even the frontline steel stocks, which supposedly are into more of value-added products, are going to face the brunt of this price differential that we have seen, especially in China. And the talk is that, right going into the winter cut season, I think there was a lot of production taking place. There was a lot of inventory built up. And now that, the winter is setting in, I think one realizes that the cuts might not be as severe. So there's a lot of inventory built up in China, which is leading to this price correction. And of course, the prices had gone up even slightly artificially because of the pent-up demand before the cut season, and now the cuts are not so severe. So I think many of these Chinese mills are now all of a sudden becoming loss-making, and probably the only way they are bailed out is by trying to export the surplus. And that's the reason why currently the landed price of export steel from China, even if I have to consider the BIS grade and everything, I think it's the differential of 2,000 to 3,000 rupees per ton. So it's definitely, I think this come December, we're going to see many of these Indian steel makers cut their prices. And the problem is that even the currency has supported the Chinese dumping. So probably that's the key reason why we are seeing some sort of weakness in many of these steel players. And I think the domestic demand is going to be very key now, because if the domestic demand were to come back, and another fear being that a lot of these NCLT cases, names like Bhushan Steel, names like Monet, all of them are again increasing their production, coming back to their normalized cash flows. That's going to add up to a lot of supply in the domestic market. So I think things look a little precarious for over the next 3 to 6 months, but all depends upon how the domestic demand pans out. In such a scenario, on further dips, I think a name like Tata Steel stands out because of its own captive mining, and certainly will have its advantage in terms of its cost of production. So even if there's a 1,000-2,000 rupee cut from 17,000 EBITDA by ton, they would go to 15,000 EBITDA per ton, which is still quite credible and satisfying their cash flow needs for servicing their debt. So I think Tata Steel would be the stock that I would bet on.
Okay, within the steel stocks, Tata Steel is what Parthiv is liking. Any trade, Aditya, within metals? Even for that matter, if you were to take Coal India, Vedanta, Hindalco, not just steel.
So most of the metal stocks continue to show weakness on the charts. Probably there can be a short covering rally today, considering the fact that markets are opening with a good gap up opening. Probably I'll bet on Tata Steel and JSW Steel. Both the stocks have corrected a little bit. So if they show some signs of strength in early morning trade, probably Tata Steel above levels of 530 can be good levels to get long. If it manages to sustain above 530, it can witness a short covering rally to levels of 540, 545, and JSW Steel probably that can too show some recovery in trade. But this will be purely a trade for a day or two, not for a positional trade. Probably it can test levels of 330 on the upside, JSW Steel. But just a short covering rally, considering the fact that the markets are opening with a big gap up opening.
Okay, some more. 8 minutes have settled down, and as we look at the Nifty 50, about 0.75%, 10,808. The macros are looking okay too, 70.10 for the currency. The bond yields at 7.61, so no complaints whatsoever on almost all counts. It looks like a day which is set to give good gains, or at least not pair some of the gains that we've had. But mind you, we've had gains for the last 2 or 3 sessions. The one stock that stands glaringly out is a Yes Bank. Sameet, Chavan, maybe you spoke about it already, but I want to readdress this, because on a good day too, Yes Bank continues to slide lower after that 11% slam dunk yesterday and breaking that crucial support of 165, currently at 167. Is there any key support level that exists in Yes Bank in the near time, or would you believe that those supports are some levels away?
See, Neeraj, ever since this stock, tanked more than 30-40% in a day on 21st September, since then we have been clearly avoiding this counter. This stock has been underperforming, and at least in the near term we see some kind of volatility happening. So if you see overall the daily range has widened, so as a retail trader one should avoid this counter, and we have been clearly advising on exiting this particular counter on any rally. In last 3 to 4 weeks, this stock has been oscillating within the boundaries of a triangle pattern, and yesterday there was a decisive breakdown from this triangle pattern, and before that also we were quite convinced that this stock will go on to break that important level of 160 and then head towards 140 or 135 odd level. So we continue to remain cautious, negative on this particular counter. One should avoid catching such kind of falling knives, and any bounce back in this particular counter would be an exit opportunity.
Minutes away from market open, let's tell you all that you need to know to stay ahead in trade today. So first up, sources have told Bloomberg News that Unilever has edged out Nestle in the contest for GSK's $4 billion Indian consumer health unit.
Another blow for Yes Bank as ICRA downgrades the bank's long-term ratings, cuts Tier 2 bond program ratings to AA from AA+.
Tata Steel tells analysts that it aims to grow only in India market with a production target of 30 million tons by 2025.
Secure Logistics wins contracts worth 364 crores by Mahanandi Coalfields for extraction of coal and allied transport services in Odisha.
In key bulk deals, Amansa Holdings acquires 2.9 lakh shares of Shankara Building Products at 676 rupees per share. The company is scheduled to hold an analyst call tomorrow.
And in brokerage calls, Macquarie raises Jubilant Life's target to 1,068 rupees as they factor in an improved operating performance.
Well, 3 minutes left for the markets to kickstart trade. Parthiv, we 10,800 for everybody who was looking for a dip to come in. It hasn't quite. Let's assume somebody wants to put in money into a stock right now. What's a good fundamental idea to invest fresh money in?
Yes, Neeraj, I think I have one stock and I'll take some time to explain the story about it. It's Linde India. Now, we all know it's a delisting story. But it's a clear proxy to play for not only the steel sector. One has a view that Linde only supplies industrial gases to only the steel sector. No doubt that is the bulk of their revenue. But I think they have innovated very smartly to go into different verticals like food processing and many other verticals where they can have a nice setup and where the demand is also very strong. But I think if you see the setup in terms of the shareholding pattern, they need around 15% of approval for the delisting, of which 10% is held by a strong entity like Reliance Mutual Fund and the entire group. So I'm quite confident they are not the ones who are going to tender in very cheap. And one rationale for this delisting is certainly the Prixar merger. So I think definitely they want to get this delisting done before the Prixar merger takes place because of the CCI deal. They certainly have to cut off on some of their assets. So I think in that case, My sense is, worst case, I think the risk being that the delisting does not take place. What happens? I think the stock reverts back to its fundamental valuations, which we have calculated to somewhere around 500 rupees a share. And if I were to add in the synergies of Rixar, I think it's little more. So I think the risk reward is extremely favorable. We have seen in the past that many of these MNCs are willing to pay a lot higher, and from the last time that they did not go ahead with the delisting, the currency is also depreciated by 35%. So that also adds to their advantage in terms of their price to acquire the shares. So I'm very confident that, here is a case where over the next 3 to 4 months, this delisting can pan out. And if at all, I think if it pans out, the risk reward is almost gains of 30 to 40% vis-a-vis a loss of 15 to 20%. So I think it's a high risk bet, but certainly as an investment call and as a positional bet, I would like to go in for Linde India.
Okay, 1 minute left to go for market opening. Quick top calls from both our technical experts. Sameet, let's start off with you.
See, we would expect some kind of short covering to happen in mid-cap counters and metal counters. So BML is the one stock that we are liking. One can go long in BML for a target of 828, stop loss 757. And from metal space, we have been contra biased since last couple of days on Tata Steel. There are multiple Fibonacci ratios that are converging around 510. So Tata Steel is poised for a decent move. 543, 548, these are the next level to watch out for. One can go long with a stop loss of 509.
Okay. Aditya?
I'll go long on DMart. Towards the closing end of the session, yesterday's stock saw a good bump up. Volumes were good in trade yesterday. So along in DMart, targets out here will be 1550. I'll put a stop at 1400.
Parthiv, take a moment to thank you, of course, for joining in today and giving us your views. Keep in mind, JSW Steel, Parthiv comes and speaks to us today at 9:30. You may want to tune in for that. But here's how the markets are starting off. This Thursday morning, expect a fair bit of green. So 4th day on a trot, we'll have green on the screen. Let's see if we end this strong. But the world markets will be a happy place in all likelihood. So we may well continue. But while 1% higher for the Sensex, the Nifty Bank not quite participating as well. But let's give it some time. Then Nifty too about 0.63%. So in line with what I believe the SGX Nifty was indicating for our markets. The mid caps and the small caps should come up on your screen, and let's see if those indices are reacting positively. 0.5% higher for the mid cap space and the small caps, about 0.25% in the green. But well, these will take some time to warm up. Let's bring up the heat map and see what's moving and what's not. Start off with the green today. No big exaggerated reactions, but we have green on the screen. So Vedanta, Hindalco and the commodity pack is doing well. BPCL, HP, IOC, the ones which had fallen quite a bit in trade yesterday, are seemingly doing okay. Reliance Industries continues to move on. 3 days or 4 days on a trot now. Ever since I think that Bank of America Merrill Lynch note came out, Reliance has done only one thing, and that's gone up. Not too many losers, save for Yes Bank. That is down another 5% in the session today. Slew of downgrades, lots of question marks around it. And I know a lot of people would have wanted to buy a Yes Bank at 180 odd, and maybe people did as well. I think it's now really succumbing to some serious selling pressure. 157 or 156 would be the price in today's session, I guess. So not the best of starts for Yes Bank. ONGC is a little bit soft in trade today, and I doubt that IT, which had a big bang move in trade yesterday, can have the same aggression in today's session. The day, at least the morning, seems to favor the high beta pack. Let's wait and watch if that indeed continues. But Devina, what are you spotting at the broader end of the spectrum?
All right, so you've got a Bharat Electricals, which is down 5.5%. REC and PFC, yesterday's big losers on the back of the Bloomberg news regarding government pushing the merger of these two. REC is down 1.9%, PFC is also down another 1.6%. 1% beverages down 2%. You've got an Adani Transmission. Yesterday's session was weak. Today, yet again, another 1.5% given out. Coal India, that's a down 2. You have a Divan Housing, which is down 1.25. The likes of an Emphasis now turning around. Yesterday was up about 5%. Today sees a cut of about 1%. KPIT Tech as well. So the mid-cap IT basket, a few of the names starting to peter off from yesterday's highs that we saw. Aside from that, the likes of a Repco Home Finance, then you've got a Wellspun India, you've got an Exide. These are the names that are looking weak as we start off a trade this morning. Amongst the stocks that are gaining ground, you've got the likes of, again, an 8K Miles at Upper Circuit, the likes of a GSK Consumer, that's up 2.5%. L&T Financial Holdings, that's up to 0.3%. Imami, Bhushan Steel, GVK Power and Infra, and Indoco Remedies. We were talking about how they're starting a new API facility in Maharashtra. The stock's up about 2.25% right now. So that's Indoco. And you should pull up Sikar Logistics as well. We were talking about the contract it received, I think about 364 odd crores. Stock's up about 7%.
No. Okay, interesting movers. Just quick opening thoughts from our experts before we let them go. And Sameet, Chavan, your opening thoughts. We've cooled off a little bit from the highs of the day, but 4 straight days of gains. Do you think there could be more gains today? We are at about 10,787 currently on the Nifty.
See, at the opening, we have opened at a crucial juncture. We are slightly above 200-day moving average. Also, the 4th October gap has been filled. So first half an hour, we would expect some kind of consolidation. As I said in my opening remarks also, Nifty has to stay beyond 10,800. So after an half an hour, if you see index staying beyond today's high, which is around 10,810, then it could certainly extend this move towards 10,860 and 10,900.
Okay, Aditya, what about you?
I would agree with Sumit out here. Markets have given up gains post the gap up opening, and look at the broader markets. They've given up gains rather drastically fast. So I would wait for markets to consolidate further, close to about 750, 760. If Nifty manages to hold those levels, probably I'll go long in the market for targets of 10,860 and 10,900 as well. But I'll wait for some more time for markets to settle down and close to about 10,750, 760. If they manage to hold on to these levels, yes, I'll go long.
Okay, got that. Gentlemen, thanks very much for joining in, Sameet as well as Aditya.
Pleasure.
Appreciate both of you taking out the time. Let's get in another important voice, Harsha Upadhyaya, CIO for Equities at Kotak Mutual Fund. He's joining us on the show right now. Harsha, good morning to you. Obviously, this week in particular started off on a big bang note. We've carried forward now once again rescaling those levels of 10,800 odd. Primarily driven by some cheer within the global markets and commentary coming in from the Fed chairman about interest rates and the pace of that. But what's your sense in the overall setup right now? Where are we expected to head?
As far as Indian markets were concerned, there were a couple of concerns to begin with in the last couple of months. Our own local NBFC funding issues and the liquidity squeeze therein. The adverse impact of crude and currency moves, and also some bit of concerns about the interest rate trajectory going forward. Out of these concerns, I think most of them seem to have resolved themselves or in the process of slowly moderating. So to that extent, there has been a positive undertone to the market. But at the same time, we have to remember that there are a couple of big events in front of us as far as Indian equities are concerned. One is obviously the state election results, which will come in the mid of December. And thereafter, I think, depending on the state election results, there will be a lot of developments that will happen on the political side, which will also drive sentiments until the final election results are out. So to that extent, we tend to believe that the next 6 months could be a phase for consolidation in Indian equities.
Obviously the volatility right now is still expected to remain considering elections that are around the corner. But for an investor who's probably looking at value picking right now from a 5-year standpoint, churning his portfolio a bit, making sure that there is a right balance of defensives, come high beta, where would those changes likely occur according to you?
Clearly, large cap segment has been more stable compared to mid and small cap segments over the last 12-18 months. So to that extent, any portfolio that has withstood the recent volatility should start making some investment picks in the mid and small cap basket, in our opinion. And that is where the valuations have corrected significantly from the peak. In many cases, the valuations have corrected by 30 to 40%. And those are the names, if you believe that in terms of earnings growth rates, they will still sustain the earnings growth rates that we were predicting earlier. At 30-40% lower valuations, definitely they become reasonably good buys. At the same time, I don't think it is still time to go very, very aggressive on mid and small caps. There are pockets of overvaluation even there. So it has to be more of a stock-specific picking within mid and small cap segment, with a view that over the next 6 months you would build a portfolio which will have a larger component of mid and small caps. And post-elections, if you find a stable government, that should give you reasonably strong returns over the next 3-5 years.
Harsha, good morning. Neeraj here. When we're talking about this phase of consolidation, would you expect that to happen even if the Fed would go slightly slower on the rate hike trajectory and global flows might come into India? I mean, how have we viewed such cycles in the past? Because I don't think this has happened too many times wherein FIs would get a left out feeling because they have sold out at a time when the Indian markets have consolidated and actually come back to those 17, 18p multiples.
Neeraj, our view is big chunks of money may not come in before elections until and unless the valuations become even cheaper and a compelling one. So if markets remain at these kind of valuations, yes, there could be a little bit of positive bias that will come because of the likely delay in the interest rate hike cycle in US and other markets around the world. But I don't think large chunks of money would come in before elections if current valuations hold. So either we need a time correction or we need a value correction. So then only I think we will see big amounts of money from foreign investors. As far as the domestic liquidity is concerned, I think the retail investors have been working very smart and they have been putting money through SIP. And we haven't seen any change in that momentum despite some of the local issues and despite volatility that we have seen in the market. So to that extent, that flow should remain quite strong even going forward.
Okay. So what could bring about that valuation correction, if I can kind of dwell upon it a bit, Harsha? The Fed fears seem to be receding for now. I wouldn't call it out of the window because we don't know what the Fed will do. But let's assume that it's parked on the side for the time being. If indeed the G20 proves out to be a non-event of sorts, and even out there people have said if the trade war comes in, India is actually in a sweet spot. Having said that, let's assume that the G20 pass off uneventful and the election results don't throw up any negative surprises from a market perspective. What can bring about a valuation correction?
I think apart from the issues that you mentioned, assuming that they don't really spook the markets, the other issue that we will have to look at would be the earnings growth trajectory. We have already seen downgrades for FY19 numbers after the second quarter results, and third quarter will also have some impact of higher crude prices and hence higher raw material and fuel costs for Indian manufacturing. We have seen the liquidity tightness that has come into NBFC market, which means the lending that would happen from an NBFC segment would also take a hit during this quarter and maybe for the next few months. Given all this, we could see some bit of slowdown in discretionary consumption along with some elevated raw material or fuel costs, which eventually would become a tailwind, but at least for this quarter there could be some impact in terms of lower margins on the profitability side. So given all this, the current valuations are not so compelling. I'm not saying that one should be looking at exiting equities or reducing equities at this point of time, but to make a clear case for increasing investments, there needs to be a lower valuation, and that could come by because of the earnings risk that the market is carrying.
You believe that there is a higher probability, Harsha, at the end of quarter two? I mean, what H1 has done for us. And just a word on where do you think or which sector or which space do you think is the most vulnerable for a market disappointment on the earnings front? Or where is it that you believe the earnings uptick will not be as much as the market seems to be believing?
I think clearly consumption-oriented sectors are running that risk. We have seen volumes slow down in case of automobiles and other discretionary consumption items. While on the consumer staple side, the volume growth and the margin performance has been very, very strong. What we need to see is where the valuations are. I mean, most of the consumer staple names are at historically high valuations. So to that extent, even a small miss there could also lead to corrections in those set of stocks. So overall, we believe consumption is one area which has done very, very well for last 4-5 years. And we have seen volume growth which has been very steady and strong. We have seen margin expanding. We have seen market share gains for at least the listed space. I think that issue could come under some bit of strain if we see this NBFC funding issue and related liquidity issues get extended over the next few months.
Right. Just comment on, the commodity-related plays right now, Harsha, be it on the back of crude, be it on the back of what's been happening in China with regards to steel prices coming off, and the implications thereof within the equity markets here, and whether or not the inter-commodity plays are something that you would look at favorably.
We continue to remain underweight on the global commodities because we really do not see the entire risk of tariff war evaporating at this point of time. There is some more clarity that we require until we take a view on the tariff war, how it's going to pan out. And secondly, given the fact that global growth is tapering, the demand side is also looking relatively weak compared to where we were maybe 12 or 18 months back. Both these issues put together, I think while we have seen correction in some of the global commodities, that could continue for some time, or we may not see real bounce back in some of the business fundamentals therein. Instead, we are playing a local commodity which has very, very strong growth trajectory as of now, and we have also seen some of the raw material and the fuel costs coming off, which is in the cement sector, and the strength in the volume growth gives us confidence that over the next 2-3 years, this should be a sector which will deliver much higher returns than the market. One, it is not leveraged in terms of financial leverage, and there is a lot of unused capacity on the production side. And in a sector where the demand is growing at mid-teen level, slowly and surely you will see capacity utilization rates inching up, and we have also seen some of the cost pressures easing in the recent times, both of which put together we should see a reasonably strong outperformance from this sector.
Okay, that's for the cement space. Harsha, the other pocket is obviously going to be IT. Mid-cap IT in particular, we've seen the rise and fall of it. You've seen specific stocks just zoom ahead and valuations looking a little bit more stretched. They had their recent downfall as well. But do you see a case for, any of these companies probably taking it to the next big league? Maybe in the form of innovation, not just pure play IT, but just focusing on specific segments and creating a niche for themselves to take that big leap of growth?
While I do not want to comment on stock-specific opportunities, the valuations that were there in the mid-cap IT segment were not comfortable, at least for us. In fact, if you remember our earlier interactions, we were always concerned about the mid-cap IT valuations because the growth rates were more or less similar to large-cap or in some cases even lower than large-cap IT stocks, but the valuations were at a premium to large-cap IT stocks. And that has corrected quite nicely in the recent pullback. Now the valuations are no more a risk for mid-cap IT companies. But then again, I think you will have to be focusing on the kind of areas in which they are operating and what kind of capabilities they have to move to the big league. And if you believe that any company has those kind of strengths, then at these valuations, they are reasonably good investment ideas.
Okay, Harsha, just the new norm, and even that's under threat, by the way, today, with the currency almost ready to shoot on the upside and northwards of 70 yet again. But if you will, the new normal seems to be that while crude has recovered and everything else has been volatile, the rupee is sub 70. Now, my question to you is there a case for either import substituting spaces to do really well. You spoke about one export-oriented pocket. The others would be subject to business feasibility. But would you believe import substitution could be a big theme over the course of the next 12 to 18 months as the currency kind of plays favor to that swing too?
It could happen, but we'll have to wait and see which of those industries would really be able to compete with the quality or whether those industries have excess manufacturing capacity at this point of time. So still it is not a very clear trade to us, but yes, there will be some benefit that will happen to at least some of the industry segments which are closely linked to rupee dollar equation, and at lower rupee levels obviously that competitive advantage for Indian manufacturing will go up.
Harsha, I know you don't, I don't want to get into a stock specific discussion, but what would happen in a case of a large bank which is going through multiple pressure points and not just one? Even if valuations were to be favorable, and I'm just talking about what's happened to certain other pieces in the past as well. This is not a yes bank specific question or discussion, but what would happen to such instances? Would the market not feel tempted to buy into a really into the valuations because the certainty around the operations and the quality of management and the board, etc., is in question? Do you think the market will continue to shun such cases? It's happened with a couple of other private banks in the past as well.
Usually, if you look at any stock which comes under corporate governance controversy or some of the issues which could completely change the business scenario, then ideally most investors would wait for some kind of a clarity or a roadmap in terms of where the our future is headed. Once that is clear, slowly people will start looking at some of those businesses once again. But as long as the controversy remains or where clarity is still not coming by, then I would say that I mean there is always a question in terms of valuations as well, because while some people may believe that the valuations have corrected quite a bit, there could be other section of market participants who would feel that even with the lower valuations there is still no clarity, and those valuations could be just optical. So there will always be two views in case of uncertainty, and markets really don't like uncertainty, and that's what happens in some of those cases.
Okay, interesting. The other pocket, Harsha, which and I heard you mention at the start of the conversation that you believe consumption-oriented names could have a case of earnings disappointment. Now, let's break it up. And I don't want to talk about staples, but more the discretionary side. They've already shown chinks in the armor, and the market has already discounted some bit of it. Auto names have come off and come off quite rapidly. Large auto anchors have also come off quite rapidly from the highs that they were trading at. So valuation may not strictly be the concern out here. What would happen here, autos in particular? Would it be a concern on growth and therefore they stay sideways? Or would you presume that there will be a bounce at some point of time in the auto space?
Our view is if margins are going to be under pressure and the volumes are unlikely to show similar strength as what we have seen in the past, they could be case for earnings revision, downward revisions in case of at least some of the auto companies. If that were to happen, even after witnessing some amount of correction from the peak valuations, the valuation may still look on the higher side, because remember these are the set of stocks which have done really well over the last 5-6 years, and there was a case for them to really do well as well. I mean, the volume growth generally was very, very strong. They had no pressure on the margins, there were no discounts in the market, and it was very smooth for the entire basket. And now, on the back of that, we have seen the valuations going up, and much more than where they were historically trading or where the market was trading, in at least in some cases. And if in those names the growth becomes an issue, then I think there is a case for valuation correction as well. But other than that, if volume growth doesn't come through, broadly most of these stocks would at best move sideways.
Harsha, One sector obviously that's in focus of late has been the real estate space now, and the NBFC exposure that they have to some of these bigger real estate players and what's been happening thereof. Most of the real estate players though feel that they're in a comfortable position to service all of those borrowings via the lease rental model. But what's your take on the space as a whole, and whether or not we'll do see a turnaround anytime soon?
We believe that the current issue is still not fully resolved. There is some bit of pressure on the real estate developers and the companies in terms of availability of money. Most of these names, especially the suspect ones, were getting money from NBFC segment rather than banks. And also, mind you, the banks cannot lend as per the regulations for land purchases. And most of the land purchases where the cash flow would come in over a period of time, not immediately, were financed by NBFC segment. So that is something that one needs to watch out for, and that is where the pressure would start coming in. If you believe that the NBFCs will be unable to roll over some of those loans lent to developers in the next few months or next few quarters, who is going to fund those land banks? Because banks are unlikely to, and they're not allowed to fund those land banks. So we'll have to wait and see how this pans out. At the same time, we all know that the purchases on the real estate side have not been very encouraging for quite some time now. So given slow movement of inventory and the funding issues that are coming up, we would remain cautious on this sector.
Harsha, my final question really, and that's got to do with not a stock really, but that stock is in the 52-week highs, and that prompts me to bring that question on par. Adani Par is the one that I was talking about. But, this Supreme Court ruling which asks the two bodies to come to a solution, amicable solution, and maybe it works to the favor of Adani Par and Tata Power, but that notwithstanding, do you reckon that the higher merchant power rates, the increasing demand at peak as well, and the fact that there could be a resolution, all of this put this pocket in a sweet spot from an investment perspective, or is it something that you're not quite convinced about?
Currently, we do not have any positions in the power generation sector. We may have players who have some merchant capacity and who will gain if demand continues to remain strong and if merchant rates continue climbing up. But other than that, we have not taken a big call on the power generation segment. As you rightly mentioned, there are still large litigations that are going on, and we really do not want to get into something where there is so much of uncertainty at this point of time. So we have been very cautious on the sector even today.
Got that. Harsha, thanks very much for joining us. Really appreciate you taking out the time. Always a pleasure chatting with you.
Thanks, Devin.
All right, that's Harsha Upadhyaya there talking about markets and a lot more. For ourselves, 10,800, we've held fort there. So looking strong on the Nifty, up about 0.75%. Sensex also about 36,000. So key milestone levels there on both the Nifty as well as the Sensex. Bank Nifty though, a marginal underperformance versus the benchmark indices. Should pull up the currency as well to see whether or not that strength still manages to hold. So come off a bit, so 70.06 to 70.13, but nonetheless a good 0.7% strength in this morning session.
Yeah, but just shows how varied this move uptick has been, because there is only one stock worth mentioning in the list of 52-week highs, and that is Adani Power. There's not enough wealth creation out there at the broader end of the spectrum, to be honest. But yeah, metals ruling the roost. Vedanta, Hindalco, Tata Steel and JSW Steel are amongst the names which are trading higher in the session today. Really, that's the bucket which is doing really well for itself. But maybe there is more in store. We'll talk about some of these a bit later on as well. But we slip into a short break. Lots more coming up on the other side. Stay tuned to Bloomberg Quint Live.